Hello and welcome, everyone. Today, we embark on a journey to learn how to invest like a pro and avoid the common mistakes that can trip up even seasoned investors. Whether you're just starting or looking to refine your investment strategy, this guide will provide you with valuable insights to help you make informed decisions. Investing is not a get-rich-quick scheme, and it certainly isn't a one-size-fits-all endeavor. Instead, it's a long-term commitment that requires patience, knowledge, and discipline. In this first chapter, we'll lay the foundation by exploring the fundamentals of smart investing. Set clear financial goals. The first step in becoming a successful investor is to define your financial goals. What are you investing for? Is it retirement, buying a home, funding your child's education, or simply growing your wealth? By setting clear and achievable goals, you'll have a roadmap to guide your investment decisions. Remember, your goals should be specific, measurable, and time-bound. This will help you determine your risk tolerance and the appropriate investment vehicles to use. For example, if you're investing for retirement and have several decades ahead of you, you can afford to take on more risk than someone saving for a short-term goal, like a down payment on a house. Understand risk and reward. Risk is an integral part of investing. No investment is entirely risk-free, and it's crucial to understand the relationship between risk and reward. Generally, investments with higher potential returns also come with greater risk. Conversely, safer investments typically offer lower returns. To avoid common mistakes, don't let the allure of high returns blind you to the associated risks. Consider your risk tolerance carefully and allocate your investments accordingly. Diversifying your portfolio by spreading your investments across different asset classes can help manage risk while still pursuing reasonable returns. Do your research. Investing without adequate research is akin to gambling. Before putting your hard-earned money into any investment, take the time to educate yourself. Study the investment options available to you, whether it's stocks, bonds, real estate, or mutual funds. Understand how they work, their historical performance, and the factors that can influence their value. Additionally, research the companies or assets you plan to invest in. Look at their financial health, growth prospects, and competitive position within their industry. Thorough research can help you make informed investment decisions and avoid the pitfall of following the herd. Create a diversified portfolio. Diversification is a cornerstone of smart investing. Spreading your investments across different asset classes and industries can reduce risk and increase the stability of your portfolio. It's the old adage of not putting all your eggs in one basket. By diversifying, you can potentially limit losses in one area while benefiting from gains in another. For instance, if you invest solely in one stock and it experiences a significant decline, your entire investment could be at risk. However, if you have a diversified portfolio that includes various stocks, bonds, and other assets, a single poor-performing investment won't have as dramatic an impact on your overall portfolio. Keep costs low. Investing is not just about making smart choices with your money, it's also about minimizing costs. Fees and expenses associated with investments can eat into your returns over time. Be mindful of transaction costs, management fees, and taxes. One common mistake is trading too frequently, which can result in high brokerage fees and capital gains taxes. Instead, adopt a long-term perspective and avoid unnecessary turnover in your portfolio. Consider low-cost index funds or exchange-traded funds, ETFs, as cost-effective investment options. Avoid emotional decisions. Emotions can be a significant stumbling block in investing. Fear and greed often drive impulsive decisions that can lead to losses. It's essential to stay disciplined and stick to your investment plan, even during market fluctuations. Market volatility is a normal part of investing, and it's crucial not to panic when markets dip. Historically, markets have rebounded from downturns, and selling investments during a market crash can result in significant losses. Maintain a long-term perspective and avoid making decisions based on short-term emotions. Continuously monitor and adjust. Investing is not a set-it-and-forget-it activity. Regularly review your portfolio to ensure it aligns with your financial goals and risk tolerance. If your circumstances change or your goals evolve, be prepared to adjust your investment strategy accordingly. Keep an eye on your investment's performance and make changes when necessary. This might involve rebalancing your portfolio to maintain your desired asset allocation or reallocating assets based on changing market conditions. Stay informed about economic developments and market trends to make informed decisions. In conclusion, this first chapter has provided you with the foundational principles of smart investing. Setting clear goals, understanding risk and reward, conducting thorough research, diversifying your portfolio, minimizing costs, and avoiding emotional decisions are key steps to success. Stocks. Investing in individual stocks is one of the most well-known and widely practiced investment strategies. When you buy shares of a company's stock, you essentially become a partial owner of that company. Stocks offer the potential for significant capital appreciation over time, making them a popular choice for long-term investors. However, it's essential to conduct thorough research before investing in individual stocks. Consider factors like the company's financial health, growth prospects, and competitive position within its industry. Diversify your stock investments across different industries to spread risk. Bonds. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. When you invest in bonds, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks and can provide a stable source of income. The key consideration with bonds is their credit quality. Higher-rated bonds are typically safer but offer lower yields, while lower-rated bonds carry higher yields but come with greater risk. Balancing your bond portfolio's risk and return can be essential for achieving your financial goals. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional portfolio managers, making them a convenient way for individuals to access diversified investments without having to choose individual securities. When selecting mutual funds, pay attention to fees and expenses, as they can vary widely. Low-cost index funds and ETFs can be an excellent choice for cost-conscious investors. Ensure that the fund's objectives align with your own investment goals. Exchange-traded funds, ETFs. ETFs are similar to mutual funds, but are traded on stock exchanges like individual stocks. They offer diversification and liquidity, and their expenses tend to be lower than those of actively managed mutual funds. ETFs can be an excellent choice for investors looking to build a diversified portfolio with flexibility. Real estate. Investing in real estate involves purchasing physical properties, such as residential or commercial real estate, or investing indirectly through real estate investment trusts, REITs. Real estate can provide rental income and potential appreciation in property values. It can also add diversification to your investment portfolio. Before diving into real estate, thoroughly research the local market, property management, and potential risks. Real estate investments can require significant capital, so it's essential to assess your financial capacity. Commodities. Commodities are physical goods like gold, oil, agricultural products, or even digital currencies like Bitcoin. Investing in commodities can serve as a hedge against inflation and provide diversification. However, commodity prices can be highly volatile, so it's crucial to understand the market dynamics and the specific commodity you're investing in. Alternative investments. Alternative investments encompass a wide range of assets beyond traditional stocks and bonds. These can include hedge funds, private equity, venture capital, and more. While alternative investments can offer diversification and the potential for high returns, they often come with higher fees and less liquidity. Before considering alternative investments, it's crucial to have a clear understanding of your risk tolerance and investment horizon. These assets are generally better suited for experienced investors and may require significant due diligence. Dollar cost averaging, DCA. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can help reduce the impact of market volatility on your investments. By consistently buying more shares when prices are low and fewer shares when prices are high, you can potentially lower your average cost per share over time. In summary, building your investment toolbox involves understanding various asset classes, including stocks, bonds, mutual funds, ETFs, real estate, commodities, and alternative investments. Each of these options comes with its unique risks and rewards. The key to success is to diversify your portfolio, align your investments with your financial goals, and stay informed about market developments. Define your investment strategy. A clear and consistent investment strategy is crucial for achieving your financial goals. Decide whether you want to be a passive or active investor. Passive investors often choose low-cost index funds or ETFs that track the market, while active investors seek to outperform the market by selecting individual investments. Set realistic expectations. Investing is a long-term endeavor, and it's essential to set realistic expectations. Don't expect to get rich overnight or consistently beat the market. Instead, focus on your financial goals and the time horizon you've established. Keep in mind that markets go through ups and downs, and your portfolio's performance may vary from year to year. Asset allocation. Asset allocation involves determining the percentage of your portfolio allocated to different asset classes, such as stocks, bonds, and cash. Your asset allocation should reflect your risk tolerance, time horizon, and financial goals. Rebalance your portfolio periodically to maintain your desired asset allocation. Risk management. Risk management is about protecting your investments from unexpected events. Consider using tools like stop-loss orders to limit potential losses on individual investments. Maintain an emergency fund to cover unexpected expenses so you don't have to dip into your investments during emergencies.